Right guys, this is the next video, which is on capital gains tax. Now, as we've seen before, the government taxes people on their earnings, and capital gains are earnings made on any investments. So the investments we're talking about here are shares, and buying and selling them. So the government has this capital gains tax, which is a tax applied to any capital gains that people might make. So a formula for that, again, is quite simple. The capital gains tax is the capital gain, which you learned how to calculate in the last video, times by the marginal tax rate, and you'll be given the percentage in the question. You don't need to remember. It's not based on a tax table like we did with business income. However, the capital gain amount that you use in there, that changes depending on whether you've held onto the shares for less than 12 months or more than 12 months. So what happens is, if we can fit this in here, if you hold on to the shares for less than 12 months, then your capital gain is as normal. Capital gain is just total return, take total cost, as normal. But if you hold on to the shares for more than 12 months, then your capital gain is actually has a 50% discount, or it's halved. So it's total return, take total cost, times by 50%. 50% as a decimal is times by 0.5. So capital gain is halved for that. So the result of this, really, and you should be able to do some quick maths in your head, is that people are encouraged to hold on to their shares for at least a year, because, as you can see, the capital gains tax that you have to pay is going to be bigger because you're timesing by the whole capital gain instead of the half capital gain that you would if you held on the shares for more than 12 months. So people are encouraged to hold on to their shares for at least a year as a result of these rules, and you will always pay less tax if you keep the shares for at least half a year, because your capital gain for tax purposes is going to be half as much. So let's run through an example. We're going to go with those same 1200 Telstra shares that we've been talking about in all of the buying and selling shares videos. So if you had a situation where you had those 1200 Telstra shares and you could sell them 10 months after buying for $605.64 capital gain. However, if you could sell those shares for that same capital gain, $605.64, 13 months, so after 12 months of holding them, 13 months after buying them, how much better off would you be? And you'd be assuming a marginal tax rate of 40%. So keep an eye on these questions, they will tell you. So what I'm going to do is I'm going to halve the screen. And so I'm going to do the 10 months here, and the 13 months there. And so capital gain for the 10 months is going to be straight up the $605.64, because they've held it for less than 12 months, so they don't get the half discount. Just going to be that straight up. So capital gains tax is the capital gain, $605.64, times by the marginal tax rate, which is 40%, so 0.4. So putting that in the calculator, so they're going to pay $242.26 to do decimal places in capital gains tax. So the after-tax return, actually how much money they're going to get from this investment, because they're not going to be getting the capital gain, they're going to be getting the capital gain minus the capital gains tax. So the after-tax return is going to be $605.64, take $242.26. Chuck that in the calculator. 242.26. So that's going to be $363.38. So that's what he's going to get back from this investment after 10 months if he does that. After 13 months though, capital gain is going to be that $605.64, but halved or with a 50% discount. So that's going to be 605.64 times by 0.5. That's going to be 605.64 times by 0.5. $302.82 capital gain if he does it, if he holds on to them for 13 months. So the capital gains tax is going to be lower because it's been worked out on half as much. That same marginal rate times by 0.4, so that's going to be $121.13. So as you can see, he's already paying less capital gains tax than he was before. And finally, the after-tax return. And that is going to be his capital gain, take the tax, $60605.64, take 121.13. That's going to be $484.51. So that is a higher return from his investment if he's held onto the shares for 13 months than he would get from holding onto them for just the 10 months. So that is how capital gains tax works, and hopefully you can see the difference between holding on to the shares for less than 12 months and then more than 12 months. Those are the kind of calculations we'll be doing, and I'll see you on the next video.